Namaskar. I am Dr. Swapna Pillai, Associate Professor, Department of Commerce at the Bhopal School of Social Sciences. Today, we are going to discuss a new topic, disposal of profits, and how the profits are utilized to give dividend and bonus shares. How the profits are utilized for distribution of dividend, distribution of bonus shares, what are the rules as per the Companies Act, what rules, specifications, conditions the companies have to follow in order to distribute dividend, who has the power to decide the distribution of dividend, and what are the rules for distribution out of the reserves. And finally, as we normally do, we will try to look at a question to understand the distribution of dividends and the rules and specifications that are to be followed or kept in mind while distributing dividend and bonus shares to the shareholders. Let us start. When companies' annual accounts are prepared and duly audited, the board of directors take decision as to how the current year's net profits as well as the profits which are carried forward from previous year should be disposed of. So while taking such decision, they consider the fact that the appropriate dividend and bonus to shareholders should be given along with the creation of adequate reserves and funds for keeping sound financial position of the company. Let us now look at the meaning of divisible profits. Divisible profits is that portion of net profits which can be statutorily distributed among the shareholders. In other words, what is left for distribution among the shareholders after transferring the desired amount of profits to various reserves and funds by the board of directors is called divisible profits. Here we need to understand that all profits are not divisible profits. Only those profits are divisible profits which can be legally distributed among the shareholders. The amount of income tax has to be deducted as well as amount of depreciation as per section 123 of the Companies Act has to be charged before dividend distribution. Interim dividend. Interim dividend means a dividend which is paid to the shareholders of a company in anticipation of profits of a period before the accounts of a company for that period have been prepared. In other words, an interim dividend is a dividend which is declared at any time between the two annual general meetings where the final dividend is declared. It can be paid if it is authorized by the articles of the company. A company must be careful to pay interim dividend since this requires that no dividend shall be declared or paid by a company unless the profit of a company are arrived at after providing for depreciation for the full financial year. Dividend on preference shares. Preference shareholders are entitled to receive a dividend at a fixed rate before any dividend is declared on equity shares. The right can be exercised subject to there being profits, and the directors recommend to pay dividend to the shareholders. In case of cumulative preference shares, the holders are entitled to receive all the dividends which are in arrear before any dividend is paid on equity shares. Dividend on partly paid shares. In case of partly paid up shares, the dividend is payable either on the nominal, called up or the paid up amount of shares, depending on the provision in this regard that there may be in the articles. In the absence of any such provision, Table F would be applicable. In such a case, the amount of dividend payable will be calculated on the amount paid up on shares, and while doing so, the dates on which the amounts were paid must be taken into account. The rate of interest is 12% according to Table F. Articles of company may prescribe a different rate. The Company Act provides various rules regarding the declaration and payment of dividend. So now let us look at the rules regarding payment of dividend. Number 1. Right to recommend the dividend. The right to recommend dividend lies with the Board of Directors. Only when the board recommends a dividend, the shareholders can declare a dividend in general meeting. However, the shareholders cannot insist the directors to recommend, even if there are sufficient profits. The directors feel that a distribution of dividend is undesirable in the interests of the financial stability of a company, they can refuse to recommend a dividend. Number 2. Right to declare a dividend. Only the shareholders in the annual general meeting can declare a dividend. The shareholders can either accept the same rate of dividend or they can even reduce the rate. However, they cannot enhance the rate of dividend recommended by the directors. Point number 3. Preparation of dividend list. Once the shareholders accord their approval to the proposed dividend, that is, dividend is declared, a dividend list is prepared in which all the details regarding dividend payable to each shareholder after tax deduction, if any, are given. Separate list is prepared for each kind of shares. Fourth point, preparation of dividend warrants. With the help of the dividend list, dividend warrants are prepared and are sent to the registered addresses of the shareholders. Dividend warrant is an order letter issued by the company directing its banker to pay the amount mentioned in that letter to the concerned shareholder. Such dividend warrants must be sent to the shareholder within 30 days of the dividend declaration. If tax has been deducted at source, each shareholder must be given a certificate of TDS also. Point number 5. Opening of dividend bank account. To make payment of dividend, the company has to open a special account in a scheduled bank which is called dividend bank account. An amount equal to the net amount of dividend payable is deposited in the said account. Shareholders can receive their dividends after producing the dividend warrants. Point number 5. Payment of dividend. Shareholders take the payments from the company's banker as and when they receive the dividend warrants. The secretary of the company collects the information from the banker periodically about the amount paid to the shareholders by certain date. The total amount paid by the end of accounting period is journalized by the company in its account. Point number 7. Payable out of profits only. The company can declare and pay a dividend only when there is a profit. In other words, dividend is payable only out of profits. If there is no profit, there can be no distribution of dividend. The Companies Act provides that a dividend can be paid only, point number 1, out of profits of the current financial year, or point number 2, out of profits of the previous year, or point number 3, out of monies provided by the central or state governments for the purpose of paying a dividend. Therefore, if a dividend is paid out of capital, it amounts to breach of trust. It amounts to an unauthorized reduction of capital and is ultra vires. Ultra vires means going beyond your authority. That means going against the rule, and therefore it is hence void. The directors shall become jointly and severally liable for taking actions beyond their authority, or in other words, for taking actions which is not within their authority. Point number 8. Provision for depreciation. It is already stated that a dividend can be declared only out of profits. The profits should be arrived only after providing for depreciation for the current year and also for all the arrears of depreciation or loss in any previous year. Section 205 of the Companies Act. However, the central government can exempt any company from this obligation in the interest of the public. Point number 9. Time limit for payment. When a dividend is declared, it should be paid within 42 days from the date of declaration. The dividend, when declared, shall become a debt due from the company. These were the rules as per the Companies Act for the distribution of dividend out of profits. Next point is declaration out of reserves. Transfer to reserves. According to provision of section 123 subsection 1 of the Companies Act 2013, it is voluntary to transfer some profits to reserves before dividend declaration. The following conditions have been imposed by the central government under Companies Declaration of Dividend out of the Reserves Rule 2014 in respect of dividend declaration out of reserves. What are the rules? The rate of dividend to be declared should not be more than the average rate of last 3 years. Number 2, the amount to be withdrawn from reserves should never be more than 10% of paid up capital and free reserves. In addition to this, the amount withdrawn must be first used to set off the losses of that financial year, and the balance of amount can be used for declaration of dividend. After withdrawal of such amount, the balance in the reserves account should never be less than 15% of the company's paid up capital. To understand these three conditions, let us now look at a question. Due to inadequacy of profits during the year, the company proposes to declare dividend out of general reserves. From the following particulars, you are to ascertain the amount which can be drawn applying the company's declaration of dividend out of reserves rule 2014. 5,000 8% preference shares of 100 each fully paid rupees 5 lakhs. 2 lakhs equity shares of 10 each fully paid, that is 20 lakhs. General reserves rupees 6 lakhs. Capital reserves on revaluation of assets rupees 1 lakh. Security premium reserve rupees 1 lakh. Surplus, that is credit balance of statement of P&L rupees 18,000. Net profit for the year rupees 1,02,000. Average rate of dividend during the last 3 years is 15%. Let us look at the solution. Amount available to the shareholders as dividend. First, we will take the surplus. Surplus as given in the balance sheet, that is credit balance of statement of P&L rupees 18,000. To that we add the net profit, that is 1,02,000. From that we deduct the dividend of preference shares, that is 5 lakhs at the rate of 8%, that is 40,000. And the total amount or the profit which is available for equity shareholders is 80,000. The following conditions have been imposed in respect of declaring dividend out of reserves. Now let us look at the various conditions. First condition, average rate of the last 3 years is 15%. On this basis, maximum dividend payable is to be 15%, that is dividend 20 lakhs into 15% is rupees 3 lakhs. As per this condition, maximum amount of dividend which can be declared would be 3 lakhs. Since only 80,000 is available for declaring the dividend, the amount to be withdrawn from the reserves shall be 3 lakhs minus 80, that is rupees 2,20,000. Second condition, how much is the maximum amount that can be withdrawn from reserves? The maximum amount that can be withdrawn from reserves shall be 10% of 5 lakhs is preference shares, 20 lakhs is equity shares, and general reserves is 6 lakhs. So this three amount is the equity shares, preference shares and the general reserves. So total of all these three is 31 lakhs, and the maximum amount that can be withdrawn is 10% of the three together. So the amount comes at rupees 3,10,000. The third condition, after the withdrawal, the balance of the reserves should not be less than 15% of the paid up capital. So what is 15% of the paid up capital? 15% of the paid up capital is 15 upon 100 multiplied by equity and preference 5 lakhs plus 20 lakhs. So 15% of the two together is rupees 3,75,000. So minimum amount should be this much, and beyond that any amount can be withdrawn. So maximum amount which can be withdrawn is rupees 6 lakhs minus 3,75,000. So the amount that can be withdrawn is rupees 2,25,000. So out of these three conditions, we have seen the amount that we had to withdraw was 2,20,000. So for 2,20,000 can be withdrawn because the balance available with us is 2,25,000. So out of 2,25,000, we can withdraw the amount of 2,20,000. So on the basis of all these conditions, rupees 2,20,000 can be withdrawn from reserves following the declaration of Dividend Rules 2014. So these are the conditions on the basis of which amount can be withdrawn from reserves. Now let us look at issue of bonus shares. What are the rules regarding issue of bonus shares? According to Section 63 of the Companies Act 2013, bonus shares are such shares which are distributed among the shareholders after capitalizing the accumulated profits and reserves. In other words, bonus shares are the additional shares issued to the existing shareholders. Effects of bonus share issue. Main effects after issuing of bonus shares are as follows. The share capital of the company increases, earning per share falls, book value per share decreases, accumulated profits and reserves also decline. On issuing the bonus shares, market price of the shares is adjusted. What are the restrictions regarding issue of bonus shares? For issuing bonus shares, capital reserves are utilized first, thereafter revenue reserves are considered. Bonus shares shall be issued to equity shareholders and not to preference shareholders. Bonus shares shall be issued either at par or at premium. These shares cannot be issued at discount. Bonus shares can be issued only after converting partly paid shares into fully paid shares. There must be an interval of 36 months between prior issue and present issue of bonus shares. Where can the company utilize the funds from? A company may utilize the following reserves for issuing fully paid bonus shares. They can do so from free reserves, from security premium reserve, from capital redemption reserve. Now let us look at a question. The balance sheet of Vishal Paints Limited as on 31st March 2014 was as follows. Equity and liabilities, share capital 8 lakh rupees, reserve and surplus, surplus that is balance of statement of P&L 2 lakhs, the dividend equalization reserve 10,000, capital reserve that is a profit on revaluation of assets that is 30,000, securities premium reserve 40,000, capital redemption reserve 75,000, general reserve 25,000, and current liabilities, the trade liabilities is 60,000. So the liabilities total is 12,40,000. Under assets, we have non-current assets. Under that, we have fixed assets. And under fixed assets, the amount is 8,40,000. And current assets, the amount is 4 lakhs. And the total of assets is 12,40,000. The company decided to distribute 2 lakhs as bonus. For this purpose, one bonus share of rupees 100 each was issued for every 4 shares held. Let us look at the solution. It was further decided to make a minimum use of the surplus, that is balance of statement of P&L. We have to give the journal entries and prepare the balance sheet after the issue of bonus share. So now let us look at the journal entries. In the books of Vishal Paints Limited, the first journal entry would be dividend equalization reserve account debit 10,000, securities premium reserve account debit rupees 40,000, capital redemption reserve account debit 75,000, general reserve account debit 25,000, surplus rupees 50,000, 2 bonus to shareholders as given in the question, amount is 2 lakh rupees being bonus declared, and this bonus would be paid in the form of equity shares. So journal entry number 2 is bonus to shareholders account debit 2 lakhs, to equity share capital 2 lakhs. So this is a bonus shares issued. Let us see the effect in the balance sheet. In the balance sheet, under equity and liabilities, we have share capital of 10 lakhs. Under reserve and surplus, we have capital reserve of 30,000. We have surplus 2 lakhs minus 50,000, that is 1 lakh 50,000. Current liabilities, trade payables is 60,000. The total remains as 12 lakh 40,000. And the assets, non-current assets, fixed assets is 8 lakh 40, current assets is 4 lakhs, and the total is 12 lakh 40. So this was a question to explain how bonus shares is issued and what is the impact on the balance sheet. So today what we have discussed disposal of profits. We have tried to understand the meaning of disposal of profits. What are the rules regarding the disposal of profits, especially when it comes to payment of dividend and bonus to shareholders. Under both the conditions, we have seen the rules as per the Companies Act, and to understand it better, we have also tried to look at examples under both the situations. This is all about disposal of profits. Thank you.